Hey guys, Eddie here from Deline Property. Today I want to do a quick video about it's tax time. It's almost tax time. It's the end of financial year. Right now it's I think halfway through June 2019, and it's my favorite time of the year because tax time for a property investor is usually extremely good. And I guess I want to do this video just to share about 5 to 6 different things about ways you can get ready for tax time, and including like what you should have ready to take to your accountant and all that kind of stuff. And just what I try to do as best as I can. Having 16 properties, there's a lot of stuff to get ready, and it takes a while to get it all ready. But I guess we'll jump right into it. So one of the things, especially for clients that we might have helped buy properties over the last 12, 24 months or longer, or even anyone just tuning in watching this video and wanting to get a bit of information about what you should have ready for tax time. If you have an investment property, and depending on the age of the property, one of the things I would definitely inquire about would be a depreciation schedule. So I'll write it down, or I'll put a brief point down there. So number one would be, I'll just put DEP, depreciation. So we'll just put debt for depreciation. So with most properties, especially if it's semi new, or even properties, I think the it's just by memory, but I think the age of the property has to be newer than 1987 or 1985 or something like that, or say newer than the 90s build. But yeah, depreciation is a massive bonus. Like I've got depreciation schedules for most of my properties. Only some of them that I bought that are really old don't have much depreciation in them, but a lot of them do, and it's a bonus. Like even if you've got properties that are neutral to positive geared or even slightly negative geared, depreciation can boost up your tax return a lot. So when I was aggressively building my property portfolio, and this is going back 3, 4, 5 years now, but I had 6 properties, and I was only on average income as well. So I got to 6 properties, I was on average income. I was getting at that stage about 80 to 85, 90% of my taxable, tax I paid back. So every year, if you've got 2, 3, 4, 5, 6 properties under your belt, and you have the right property tax accountant and all that kind of stuff, that can really help you get deductions back, especially even if they're neutral or positive. You can still claim a lot of stuff, expenses back at tax time. So that tax return might be equivalent to another property deposit, or a holiday that you've been wanting to go on or something. So if you get $15, $25, $30, $40,000 back at tax time, that's massive. You could potentially buy another property with that tax return. Or even if you get $15,000 back and you've had 15 from tax and 15 from savings, 30,000, like that, another deposit. It's another property you could add to your portfolio just for maximizing your tax return. So number one would be depreciation schedules. Make sure you've got that ready. If you need help with depreciation schedules, I can put you in contact with a great company that I get a lot of my depreciation schedules from. Number 2 would be making sure you've got your bank statements. So I'll write number 2 would just be bank, S for statements. So bank statements. So the first few properties I bought were with Commonwealth St. George and that kind of stuff, and now I've kind of scattered them around a lot of different lenders, but the majority I still like to use the big banks. A bank statement would be they'll usually do it at the end of the financial year. They'll usually send you a statement, or sometimes you can even just log into your online banking account and find out the exact figures. So how much interest you paid on that loan. So usually you can claim portions of the interest repayments back at tax time. Confirm all this is, once again, is not financial advice, or anything like that. I'm not an accountant, but from my experience, you want to make sure you have your bank statements ready for the last financial year, so you can claim that interest and all that kind of stuff, or claim portions of it back. So that's pretty massive. Another thing is rental statements. So rental statements. This is for if you've got a property manager, as an example, whether it's one of the big property managers out there or smaller companies, every end of financial year they'll give you a rental end of financial year statement, and this should have all the rent that has come in. So your total end of financial year rent, and also things like management fees that you've paid for that's come out of the rent. Things like costing for statements, admin fees, even if they did repairs on your behalf, usually it can be summarized in the annual rental statement. So you need to have that ready for tax time, of course. So that's pretty massive. Another one would be any repairs and maintenance that you've done, you've hired someone to do or you paid someone to do. So write that down. So repairs, I'll just put an M for maintenance. So repairs and maintenance, pretty massive, especially if you do repairs. You spend $5,000 on repairs on something, or $800 or $300. It's not like living in your own property. You can usually claim a good portion of that back. It's kind of like being an easy way I explain it to people, kind of like being a tradie and claiming your tools and all that kind of stuff. So if you do repairs on an investment property, it's a beautiful thing. You get to claim, bits of that money that you put into it back off your taxable income. So it's pretty awesome. So that's massive. And if you comparing that to owner occupier, if you buy a house and you live in it, you don't usually get to claim anything. So by owning investment properties, you win by growth, rental income, the leveraging money, tax benefits. It's a great thing. So another thing to make sure you've got in place or have ready for tax time is insurance statements. So I guess how much you've paid for insurance, or the tax invoices. So this comes down to all tax invoices and all that kind of stuff you need to have. So number 5 would be insurance. Mind the writing. Insurance is another one. You make sure any kind of tax invoice you paid. A good question that I had someone ask the other day, it's do you need receipts and all that kind of stuff for invoices? From my experience, if you've already, you should keep as many receipts as possible, but invoices for insurance, pest and building inspections and all that kind of stuff, you don't have to actually have a proper receipt most of the time. If you've got a proper invoice and you've stamped it as paid, as you marked it as paid, usually, depending on your accountant, that's sufficient enough. You don't usually need a receipt for everything if you've already got an invoice anyway, or a paid invoice, something that says you paid it. So hope that helps. Another one would be, last and not least, but rates. I just put rates, and that's summarizing a lot of things. So council rates, water rates, management fees, just council rates, water rates and all that kind of stuff. You can claim portions of council rates back, water rates, body corporate fees, strata fees, all that kind of stuff. So that's massive. You should really have all this kind of stuff ready, and I'm probably not the most organized person. It is good to be organized, but for me, I focus more on building my portfolio and taking action and doing those lasting changes, such as building a portfolio rather than buying one property and spending a million hours trying to make sure all this is perfect and organized, when I much prefer to be getting the process and actually buying another property and getting someone else to handle all this stuff. But yeah, so that's just from my opinion how I am. But a lot of people are not like that. They like to have everything neat and tidy. It is good to be really organized as well. So there's no right or wrong. It depends what's right for you. But I hope this helps. These are 6 key points, that things you should really have ready for tax time. And if you, having a property tax accountant is a very important facet of property investing. And it took me years and years and years to find a good property tax accountant that actually owns investment properties himself and understands. So if you need help with that or anything, just contact us at admin@delingpg.com, and we can put you in contact. I can put you in contact with who I use as well. So it's as long as they're going to do the right thing by you, and they're very property savvy as well. So years ago, I used to go to the just random, after I had 2 properties, and I grew up in a very humble beginning background. So most people that I knew growing up didn't work. They were either on the pension or whatever, so I didn't really have experience with getting tax done. So I just went to just complete randoms, and the first couple of years when I was 18, 19, 20, having 2, 3, 4 properties and starting off small, of course, I went to random tax accountants, and they didn't know what they were doing, basically. So yeah, it's good to have the right tax accountant. So I hope this video helps, guys. I look forward to chatting to you soon. If you have any questions or anything, feel free to send them through. Thanks for watching, guys. Bye.